You shouldn't pay off your mortgage. In this video, we're going to be discussing why paying off your mortgage might not be a good idea, and what are some of the strategies, tips, and tactics that you can use to not pay down your mortgage and create more wealth, like the rich do by using debt to your advantage. Now, I'm going to give you two choices. Choice number one, you can live in a mortgage-free home, but you need to work till the age of 65. That means 40 hours a week, clocking in and out for 40 years to live in this mortgage-free home. Option number two, you need to take on more debt than you could ever imagine. Millions and millions of dollars in debt. But you potentially get to retire 10, 15, 20 years earlier than your counterparts who are living in a mortgage-free home. Now, what option would you choose? I know for myself that I've ended up choosing option number two, and I'm going to explain to you why that was the decision we made. So why would you not pay off your mortgage over 30 years and take on more debt? How is that going to give you more financial choices? I probably got Dave Ramsey freaking out right now. I can hear him on the phone going, "You're crazy taking on more debt." But in my experience, leverage has been the greatest wealth creator for Emily and I in our property investing journey, and almost every property investor out there. Now, the power of leverage allows you to grow your money faster. If you have $100,000 that you could invest into the share market, or $100,000 that you could invest into the property market and control a $500,000 asset, that means that you can get growth on $500,000 versus the shares at $100,000. If the shares go up by 10%, they've gone up by $10,000 in a year, a great return. If the property goes up by 10%, you've made $50,000 of capital gains in 1 year. So essentially, using more debt allows you to hold a larger asset base, and then you're able to get compounding growth on that asset base to create more wealth. For Emily and I, our property portfolio sits around $5 million. So you do the math. If the value of our properties goes up by 10% in any given year, that means our property portfolio could go from, say, $5 million to $5.5 million, whereas someone who only has one asset, their own home, worth, say, $1 million, and that goes up by 10%, their net worth has gone up by $100,000. So if you're able to buy and accumulate and acquire these properties conservatively by managing your cash flows and using the power of leverage, that's where you can create a larger asset base for yourself. And I can already hear a lot of people saying this in the comments, but what about the interest rates? We're sitting on 6, 7, even 8% interest rates for some people at this point in time. How on earth can we buy and build a multi-million-dollar property portfolio, take on more debt, pay the mortgage, pay the school fees, have a lifestyle as well? How on earth are we supposed to balance all of that? And that's where it comes down to balancing capital growth and cash flow. Some people advocate for absolute capital growth. Buy blue chip, buy inner Sydney, buy inner Melbourne, buy inner Brisbane, and stick to buying properties between the $1 to $3 to $5 million mark if you have that capacity. Other people say buy $200,000 houses, buy $150,000 houses in Whoop Whoop or Wagga Wagga, or who knows where, regional Queensland somewhere, Roma. Buy it in a mining town with a high yield. In my opinion, I'm somewhere down the middle. I think you need both capital growth and cash flow in your property portfolio, and you need the right asset at the right point in time. If you're struggling to get the ball rolling, if we talk about snowballs here in our business, if you're struggling to get your snowball rolling and building that momentum in your property portfolio, don't let your snowball melt. Make sure you take the assets that you have available to you and invest for growth if you're short on capital growth. Or say you've got a lot of capital at your disposal, maybe you need to look at buying more cash flow. For Emily and I, we were able to balance out the capital growth and cash flow. We decided to go for growth first because we didn't have a lot of capital behind us. So creating growth was our starting point. We manufactured value. We bought in blue chip locations in established suburbs with a long-term view. I think another thing that catches a lot of people is they get short-term focused on the growth. Yes, short-term growth is great, but maybe buy in a location with short, mid, and long-term growth and manufacture value to fast-track your journey. On the flip side, you've got to look at your cash flow. So if you're talking and you're looking at this leverage and you're going 6 and 7 and 8% interest rates are too hard for me to handle, maybe look at buying some cash flow properties. Can you look at a house and granny flat scenario? Can you look at a room rental accommodation? Can you look at an Airbnb business? If you don't want to be like 93% of property investors, which get stuck at 1 to 2 properties, and you want to be someone that builds a property portfolio, you have to be willing to explore these options. So if you're struggling with the higher interest rates, maybe look at some more cash flow opportunities, or maybe look at being willing to grow your day job income to service some more debt for a period of time as you build out your property portfolio. So we've talked about leveraging up with debt. We've talked about capital growth and cash flow. Now let's talk about the power of liquidity. Now, one of the mistakes that people make is when they're paying down their own home over that 30-year period, this is what the previous generations did. They bought their home, they had their quarter-acre block, they paid down the mortgage, and they took a pension from the government in retirement. But if you're looking to create more financial choices in your 20s, 30s, 40s, and 50s, and not wait until you're 65, you might need to do things differently. And this is managing your liquidity. So what this means is using the power of offset accounts to give yourself liquidity and then potentially use those funds for more investments when the time is right. So if you went to the bank and paid down your mortgage and then you quit your day job, the bank's not going to give you that money back. The bank's not going to give you more debt against your own home or your investments to give yourself liquidity back. So what I like to do as a chartered accountant and a buyer's agent and a property investor is maintain my liquidity. So instead of paying down the debt, how do I actually manage it? So we look at offset accounts. So it's essentially reducing the interest that you're paying on your loans, but giving yourself the liquidity of managing your property portfolio. The way I like to think about it is I want to maximize my serviceability, take on as much debt as possible into my personal name, my trust structures, my company structures. The reason I do that is because I then park all of that cash in our offset accounts. And this is exactly what Emily and I have done. We want to go to the bank, go to CBA, go to second and third tier lenders, have a chat with them and say, what is the maximum borrowing capacity you're willing to lend us at 80% debt on our property portfolio? At some periods of time, we'll then refinance, pull all our cash out, park that cash in offset accounts and give ourselves maximum liquidity. This gives you choices. If I quit the business, quit working, and Emily doesn't work anymore, we still have the access to that liquidity. Whereas if we paid down all our loans and we only had $10,000 left in the bank and we were both out of work for whatever reason, the bank wouldn't be willing to give us all of that money in cash at that point in time because we didn't have the jobs to service the debt. But if you have the jobs to service the debt and then you can pull out the money into your offset accounts, it gives you more choices. It gives you an emergency fund. It gives you money to take advantage of opportunities, looking at other investments and being able to break back into the market. It gives you more security as well because you have more money at your disposal when you need it. So that's the power of taking on this debt, investment debt ideally, not owner-occupied debt. And this leads me into our next point, like a Wiggles run. Leads me into the next point over here. So we've talked about leverage, interest rates, and liquidity. How about owner-occupied versus investment debt? For me, I want to park all the offset money that we just spoke about against my owner-occupied residence. Obviously, you need to have a chat with your accountant and your broker about how you do this because you want to be careful about not diluting your loans. But at a high level, I want to park my money against my offset account for my owner-occupied residence and maximize my investment debt. What this means is I'll be paying less interest on my non-deductible debt, which is my own home, and being able to claim interest expenses in my tax returns for my investment debt. I can claim that investment debt and those investment property expenses like maintenance, insurance, council rates, and other bills, all against the income of that investment property and against your personal income, which is negative gearing. So when it comes to managing owner-occupied versus investment debt, you want to maximize your investment debt and minimize your owner-occupied debt as much as possible. Now, one thing that not everybody knows is that you can actually use your owner-occupied residence and create investment debt out of that property. What this looks like is creating enough disparity between the market valuation or the bank valuation of that property and your current debt on your own home. The remaining difference, say you're able to draw out $200,000 of equity. What Emily and I do is we create a second loan for investment purposes to draw that $200,000 of equity out of our own home, and then we can use that money as a down payment on an investment property and claim the interest expenses because those funds have been used for investment purposes. This is a massive secret and it's known as debt recycling. It's where you take your own home and as long as you use the debt directly for investment purposes, you're able to claim the interest expenses associated with that debt, even though it's secured against your own home, which is your principal place of residence and typically a non-deductible asset. I'll explain to you at the end of this video how Emily and I are potentially going to be able to draw out $1 million worth of investment debt from our own home in the next 6 to 12 months. So another major point to reconsider paying down your mortgage and look to use those funds for your future investments is compound growth. Whether you were buying into the stock market or investing in a business or investing in property, compounding growth on your investments rather than paying down debt, which is typically on your own home going to be the cheapest debt you'll ever receive, can be the right decision if you can get that compound growth on your investment assets while maintaining your cash flows on your current debt. Now, I said to you at the start of this video that I would reveal to you exactly Emily and my journey to building our multi-million-dollar property portfolio. Now, what we were able to do is we were able to buy a house for $800,000, property number one. We are able to then add value through renovations and refinance the property 18 months later after completing those renovations for $950,000, roughly. That enabled us to pull out after we'd spent about $30,000 to $40,000 in our renovations, an additional $70,000, and we were able to then go out and buy property number two. This was the Baby Queenslander, which was a renovation series here on YouTube. And we spent about $35,000 to $40,000 on those renovations. We purchased the property for $544,000 and spent $40,000 on renovations, getting a market revaluation in the low 600s. We then again were able to pull out more debt, more investment debt to build our asset base and to continue growing. And that's when we bought the triple Gable Queenslander, which is currently our own home, and we're completing a massive renovation project on it at the moment. But in 2020, we were able to buy the triple Gable Queenslander, again spend about $40,000 to $50,000 renovating the home, and increase the market value and go back to the bank and refinance. So between 2018 and 2020, we'd been able to secure 3 properties, building out our portfolio, using our serviceability, and taking on more debt than Dave Ramsey would like us to build out our asset base and get the power and effects of compound growth, using offset accounts, maintaining our liquidity, and leveraging ourselves to build the asset base. Now we got into that point, it was time to transition from growth and start to look at cash flow assets. And that's when we bought the unit block in Coffs Harbour. Purchasing the unit block in Coffs Harbour was a big shift for us. It was driving for cash flow. There were 4 to 5 leases on the unit block, generating around $75,000 to $80,000 a year of gross income. We paid $1.4 million for the property with the view that it needed renovations. It needed a new roof, new gutters, new kitchens, new flooring, new paint. It needed a cosmetic renovation upgrade. But Emily and I had the skill set and the willpower to want to take on this challenge to boost the cash flow and boost the growth in the Coffs Harbour apartment block over time. And that's exactly what we've been doing the last year or two. We popped down to Coffs Harbour around 6 months ago. We've renovated some of the units. We've added in new kitchens in 2 of the units for $10,000 each. We've had new gutters placed on the entire property because this is a long-term play for us. We've built out our growth properties. We've added cash flow assets to the mix. And that's how we've been able to achieve a property portfolio around the $5.5 million mark. The reason we were able to buy the Coffs Harbour unit block was by pulling out debt against our other assets. So against our triple Gable Queenslander, the Baby Queenslander, and our first property just a few kilometres north of Brisbane CBD, we pulled out roughly $250,000 from each of those properties. Now this was at a time when Emily and I were both working as PAYG employees, and we just started the business here at Purpose Property around 3 years ago. At this point in time, we were able to pull out all of that debt because we were both working. We had strong incomes, 6-figure salaries at that point in time because we'd worked on building up and moving up the ranks in our careers as fast as possible. Now, this was not forever. I wanted to move into the business at Purpose Property, and Emily wanted to be a mum and stay at home with our kids. So leveraging ourselves at that point in time, giving ourselves maximum liquidity and taking on more debt made sense to us. Now, to some of our friends and family, we might have seemed crazy. At that point in time, people thought we were over leveraged, we were being silly with our money and taking on too much risk. But as a chartered accountant myself, I ran the numbers, I understood the potential of the properties, and we were making investment decisions rather than owner-occupied decisions. That was the key distinction. We weren't spending the money directly on ourselves, we were spending it on building our asset base and building for our future, both from a growth and a cash flow point of view to manage and balance the property portfolio. And this leads us to today, where Emily and I have been able to amass a $5.5 million property portfolio, and I have some exciting future plans to share with you. We're currently completing our raise and build project here in Brisbane. We're roughly 5 kilometres south of Brisbane CBD, and we've taken the triple Gable Queenslander, which was our 1920s home that sat on ground level. We've lifted the home up and built in underneath. The project was estimated to cost roughly around $450,000. And in our renovation series a little later this year, I'll be revealing all of the numbers, every single trade we used as an owner builder to create more value in that property. Now, I won't reveal to you all the numbers just yet, but we're going to sell the Baby Queenslander, complete our project at the Triple Gable Queenslander, and then look to go back to the bank and refinance again. It's a continual process of managing debt, managing offset accounts, managing your cash flows to make sure you have balance in your property portfolio and you're mitigating the risks. Everyone's going to have different life goals and different risk tolerances. What I might have just explained to you around our property portfolio might freak you out and seem like too much debt and too much risk. For other people, they might have thought that we could have been more leveraged and bought more property. But for Emily and I, it was the right balance in building out our property portfolio, creating more choices for our family, and focusing on the important things in our life, which is time with family, time with friends, and choices. I'm not looking to create a $100 million portfolio to drive a Lamborghini or a Ferrari around, or to have the most expensive home here in Brisbane. I want to focus on my football, my faith, my family. Those are the things that are really important to me. So when it comes down to making the decision as to whether you should pay off your mortgage early or you should look to invest into the property market, it comes down to your risk tolerance and your personal goals. If you want to sit down and have a chat with myself and you're looking to buy a property here in the Brisbane market in the next 6 months, then head over to purposeproperty.com.au. We'll sit down, talk about your situation, talk about what we do as buyers agents here in Brisbane, and then talk about the next steps. If you even want to see me reveal addresses of recent client property purchases, then click this playlist over here. Thanks for sticking around. I'll see you in the next one. Peace.